There is an IRS tax rule that allows you to rent your home to your own business, get paid, legally pay zero taxes on that income, and still write off the rent in your business as an expense. I'm not kidding you, that is real. It's called the Augusta Rule. And if you own your home and a business, you need to understand how this works because you can benefit from it. My name is Dar Marden. I'm a realtor and CPA in Orange County. And in this video, I want to explain this rule to you. So, what is the Augusta Rule? The Augusta Rule is part of the IRS Tax Code Section 280A. What it says is that if you rent your personal residence for 14 days or less during the year, that rental income may be completely tax-free to you. That means if there is a big sporting event in your city, a convention, a festival, or some major celebration, and people are coming into your town looking for places to stay, you may be able to rent your home, make that money, and not pay any taxes on it, as long as you stay within the 14-day limit and follow the rules properly. And anybody can do it. This rule became famous in Augusta, Georgia. Homeowners were renting out their homes during the Master Golf Tournament. This is why people call it the Augusta Rule. Now, that by itself is a great deal to get that rental income and don't pay any taxes on it. But here's where it gets more interesting for business owner. If you own a business and it cannot be a sole proprietorship, your business may have a legitimate reason to rent your home. Maybe it is for a planning meeting, a strategy session, team building, board meetings, an annual Christmas party for your business, or even a client presentation. In that case, your business may be able to pay your rent for the use of your home. Then the business may be able to deduct that rent as a business expense, and you will receive that money personally, tax-free. This is why this rule gets so much attention. You may have a deduction on the business side and tax-free income on the personal side. Let me give you a simple example. Let's say the fair rental value for your home is $1,000 a day. Your business holds 10 meetings at your home during the year. Your business pays $10,000 in rent, and it writes off the $10,000 as rent expense. And if everything is done correctly, you may receive that $10,000 personally without paying any income taxes on it. That is really the basic concept. It's very simple. Let's cover some important rules. Number one, you notice me emphasizing it. You cannot do this more than 14 days in a year. Number two, the rent has to be reasonable and the fair market value of your home. You can't just come up with some crazy numbers. And number three, there has to be a legitimate business purpose. I named them previously. And number four is you need to have documentation. That means agenda, records of the meeting, who attended, and proof that the rent was actually paid. This is not something you want to do sloppy. It can be done correctly and easily, and you can take advantage of it. This is more useful for business owners that have an S Corp and C corporations that file a separate tax return. If you're self-employed without a formal entity, it may not work the same way. So you want to check with your financial advisor. The bigger point is this: owning a home is not just having a place to live. Sometimes there are tax planning opportunities connected to home ownership that people don't even realize that exist. And this is certainly one of them. It can save you, based on value of your home, $10,000, $20,000 a year. Of course, every situation is different, and you should consult your CPA or tax advisor before implementing this strategy. My goal is to simplify this kind of topics so you can make better financial decisions. As I always say, let's use this information to protect you, and let's do something great together. The link to connect with me is in the description. Take care.